It's Craig Moser. Almost Christmas, guys. A lot of stuff happening here, both in the world and in personal life. So I hope you are close to having everything ready for a wonderful Christmas and joyous time with your family and your friends, and that things are good in your world. Let's talk a little bit about what's going on in the investment world. So today is the 14th day of December. And what is happening here is we have just had another increase in interest rates from the Federal Reserve Bank. Kind of interesting. So let's see how that's impacting the world. Hang on just a second. Let me get to the handy dandy charts and we'll go right there. All right. So what we're seeing right here is, let's do the S&P 500. This is the NASDAQ. So NASDAQ was the darling of the world here for the last, I don't know, 10, 15 years, honestly. That's where all the growth has been in technology stocks and companies, maybe that don't pay dividends, but are good, solid companies. But over the past 1 year, this was actually from the 22nd of November, but close to 1 year, we've seen a series of lower highs and lower lows as we have worked through that. It's been pretty much to a T that way. Same thing for the S&P 500, which is what I typically let people tell me is the U.S. stock market. The Russell 3000 maybe is a little better choice, but this is basically saying, the same thing, a series of lower highs. And you're going to see, in my opinion, a lot more volatility out of the markets over the next two to 3 years. There's a lot happening. Think about what COVID did. COVID kind of exposed to us several things. One of them was that our supply chain world is fragile. If we cannot get things from other countries that are making this stuff for us very inexpensively, then all of a sudden we're just totally without something. So I think our world is going to change a little bit, meaning that we will start to bring your supply chains closer to home, I guess is the way to say it. Maybe not put everything in the United States, but have Mexico, have Canada, have things that are not just reliant pretty much on the eastern part of the world for access. But anyway, going back to the S&P 500, for one thing, you're seeing a series of lower highs. So the market's not in a positive trend. It was here, a series of higher highs. And you can kind of see that on the other side of the world. We're just in a different economic situation. The world is receding, recession. So that doesn't mean depression and end of the world things. It means that we're going to see a period of slow growth for GDP. We probably have inflation not going away anytime soon, because some of the things that cause inflation really don't matter or really don't care if the Fed raises interest rates. So that would be what people have paid for a wage. If you can't find somebody to work, you have to pay a higher wage until you find somebody that will work. I mean, that's kind of how that one works. And then the other one is the cost of fuel, oil. Right now today, we're what, about $75 or $76 for a barrel of oil. So, put that into perspective. Those things don't care what the Fed does or what the government says. All right, so S&P declining. If we compare, let's do a little compare here. Let's look at the other parts of the world. We'll look at Great Britain, France, Germany, Australia, Japan, those guys right there in those countries, maybe Canada, and put this into a single index, Europe, Australia, and the Far East, and compare. So looking back for 2 years, not 1 year, but 2 years, you can see that index is really no better. And depending on how you measure, if you measure over 1 year or year to date, we can look at that and see how that looks. But really, none of these guys are doing very good. And so I like the 2-year chart because you can kind of see where we overperformed and then we're still in a better place, but it depends on where you're measuring from. Okay, how about the emerging market space? So the big 3 players there, Russia, India, and China. That's not the only players in this index, mind you, but those are the three biggest positions in the emerging market space. So as we're looking through this, just understand the world at large is the markets are declining for them. And that's in part due to the fact that we are raising rates. That's due in part to the fact that a lot of time and money and concern is being pointed towards Russia, and then to a lesser extent right now to China. So, okay, people are getting a little concerned. And then the interest rates and inflation has made the cost of goods and services a lot higher, and our savings rate is starting to decline. So that matters for you individually if you're not saving as much, but it also matters, to the banking system, for example, when you see that, there's less liquidity in the world. So all of these things have a repercussion to them. Anyway, over the last 2 years, really no one has beat the US of A, just hasn't. So that's the stock market. When you look at the bond market, has perked up a little bit here because of the anticipation that the Federal Reserve is going to start to slow and perhaps even reduce some of the interest rates in the future. I'm in the club, in the camp that says, nah, I don't think they are, because interest rates are starting to have impact on the growth of the economy through the ability to get a loan and pay the interest rate and so on and so forth. And that's the intended consequence here, is to slow the economy down some. So when you look at the price, not the yield, but the price of a bond, you're seeing that has started to decline. All right, so we've got to pay attention to that and make sure that we understand that world is a little, as long as they raise interest rates, the value of bonds aren't going to go up too much. You've heard inverted yield curve. Most of right now where the interest is made the most has about a 7-year or shorter maturity. So in the 1 to 7 range, that's where all the interest rate is. And if you go further out on the yield spectrum, meaning how long before a bond matures, you're really not getting paid to take that additional risk. So the market's telling us that the shorter maturities are the better choices. Now, that also is one of the things people use a lot of times to talk about, going into a recession, inverted yield curve. And we have one of those. We'll see if that's accurate or not. When you look at gold's always a question. And that's a 2-year look at gold. And it's been up and down and up and down and up and down. The thing with gold is there's no dividend, there's no interest, there's no growth in it unless more buyers than sellers. So I don't really see that that's anything that's going to hedge your bet for inflation. I don't see that as anything that you can use to stabilize an investment portfolio. A lot of people do. I'm not here to argue with that. I'm just telling you that when I watch the prices of gold, I don't see an upward trend to the right. I just don't. All right, so I don't want to bore you here. I know you want to go shopping and spending time with friends and the things that you really want to enjoy here, and not listen to me pontificate, but just understand there's 2 or 3 things happening. This inflation thing's for real for a while. So that's not going to be a positive tailwind for investors in the markets. We have the war thing going on with Russia, and some of the other countries are who's contributing to one side versus who's contributing to the other. So that's a problem. It's a problem for Europe because of energy, and just the whole thing about the demographics of the world. We're getting older. How many of us are going to continue to work? Can the younger ones have the same productivity? Will they have the same work ethic? That's all a question that we'll have to see solved somewhere in the future. For now, things are okay. I don't see any big problems, so don't lose any sleep over it. Just understand that a recession would slow us down and would take some of this inflation cost away. It probably would make people that got laid off a little more appreciative of jobs and the wages are being paid, which might make the cost of goods and services go down a bit. Anyhow, if you have more questions, give us a call at 336-448-1086. And with that, I bid you a wonderful, wonderful end of the year and a happy new year.